Hey guys, Chris here from Eve Exchange, and today I'm going to be hosting the very first episode of Options Trading 101, part of our Eve University series. So today we're going to touch on what are options and how do they compare to futures, how are they used in TradFi, and then options in the crypto and DeFi landscape, and then finally in part two, we'll get into how you create options contracts on Eve and how you can trade them. So although you might want to just skip to part two, I suggest if you're new to options and you're new to this in general, that you probably listen in because you might find it interesting and it might help you to understand a little bit more about why we did what we did and why we built the system. So stay tuned, okay? So let's get into it. What are options and what are these things? What are we talking about? So options are interesting because they're a very old product, right? So they actually started their life in ancient Greece, believe it or not. So back in those days, there was a guy, a very smart mathematician. I forgot his name. I think it was Hermes or something. But anyway, he had the great idea of, I am going to corner the oil market, okay? Not the oil for your cars, but actually like the olive oil market, right? So he thought, based on my mathematical calculations and my like astrology, so on and so forth, I figured out that for sure we're going to have a great crop this year, and there's going to be a high demand for people to use oil presses, okay? That was his theory. That was his speculative theory. So he thought, well, I have a few ways I can make money. I can go around buying oil presses and buy up the market, or I can make a deal with the oil press owners and ask them, hey, can I, let's say, lease your machines for X amount of money for this period of time for money up front today? And so he went around Greece, and he made deals with all the important oil mill guys, right? So these are the guys that took all the olives, crushed them, turned them ultimately into olive oil, right? So he went out there and he made this deal. So what ended up happening? Of course, well, he was a very smart guy, and his prediction came true. And all the world that wanted to crush their olives and turn them into olive oil had to go to him, and he ended up making a big fortune. Okay, this is the first instance recorded of a options contract. Why was it an option? Well, he paid the money up front. For the option, he either could do this or he didn't have to do this, right? So like if there was no olive production at all that year and he had it all wrong, the only thing he would have lost is his upfront payment, okay? And that's known as a premium. So fast forward to more recent times, people have used these instruments, options, to speculate on a wide variety of outcomes, and they actually encompass the total world of finance, right? So you could have an option on spot, something like a stock or a commodity, straight vanilla commodity. You could have an option on a future. You can have an option on a bond. So the world of options is very interesting because it totally incorporates every single financial instrument out there. You could have an options trade for nearly anything out there. You could, have it's almost endless amounts of options that you could do. Real estate, you say, oh, well, I'm going to buy your house for this price, but I don't have the obligation to buy it. I'm just giving you this money up front, right? So there's so many uses for options. And what's super interesting is that in the TradFi world, options account for something like $500 trillion of notional value annually. So like, let that number sink in. $500 trillion. It's insane. And the reason why it's so big is because, like I said, it totally takes into consideration almost every single asset class out there because you can trade an option for anything. So in crypto, options have not really taken off to the level that they have in TradFi at all, like not even close. So in the perpetual product is really what has taken off in crypto and is the thing that everyone wants to trade. Now, that brings me into what are options and how do they differ from futures or perpetual products? Well, perpetual products are basically you buying a position. It's a directional trade. I think Bitcoin's going up. Well, I would love to trade 10 Bitcoin, but I don't have, $250,000 to trade 10 Bitcoin. Well, no problem. You can give a margin to an exchange and you can do 10x, 20x, 30x, goes on forever, right? Most people are trading like between 50 and 100x, which is insane. Yeah, but that's what people do. That's what people like because they get these wild profits and also wild losses. Yeah. So perpetual, you could basically put your 2,000 bucks and you could be trading $200,000 worth of Bitcoin. Let's say you were a risky guy and you wanted to do that. Well, what happens when Bitcoin moves a little bit and you wipe out your margin? Boom, contract closed. So sorry, you lost your $2,000. And that is the nature of perpetual trading. So you need either a lot of margin or you need to use very little leverage to really be safe when trading perpetuals. Not so with options. With options, it's very simple. You pay the premium and then that's it. All you have to do at that point is worry about time, okay? So with an option, you just pay, there's a few things you need to worry about. First thing is the strike price. And that is the price at which you can exercise your option, okay? So let's say in the case of Bitcoin, 25,000. The other thing you gotta worry about is time, okay? And then the last thing is the premium. So in this particular trade, let's say you think Bitcoin is gonna go long. Well, what you would do is you would buy an options contract to buy 1 Bitcoin for 30 days or whatever time period you wanted, and you would pay a premium of whatever the seller set, which maybe in this case would be something like probably like $1,500, okay? So for 1,500 bucks, you have the right to buy Bitcoin in 30 days. Anytime in the 30 days, if Bitcoin goes to 50K, you're good. If Bitcoin goes down to 10, you're still good because you still have time. So the most important component in options trading is time. Because the longer the time, the more time you have, the more probability you have that that price will probably go in the direction that you hope it to go in. And there's 1,000,001 strategies and 1,000,001 indicators you can look at to make that determination. I am not going to get into all those eventualities here. I'm just giving you the overview, okay? So this would be known as a call option. Okay, you think the price of Bitcoin is going to go up, so you buy a call option. The guy selling you the call option probably thinks Bitcoin is going to go down, but he's happy because he's getting that upfront payment, and it's probably part of an overall bigger strategy that he might be using. He might not even be taking risks because he might be selling both calls and puts. Now let's get into what is a put option. Okay, so we know a call means you think the asset's going to go up in price. What is a put? Well, put, as you guessed, it means that the price is going to go probably down, or at least you think the price is going to go down because that's what you're buying. So in the case of a put, someone will be selling you the right to buy Bitcoin, or right to sell them Bitcoin rather. So you're getting the right to sell BTC for 25K. So if BTC drops to 10K within this 30-day period, congratulations, you made 15K. So that is basically how options work. You can think of it as you call up your friends when you think the price is going to go up and you put down the phone. That means the price is going to go down. It's a silly thing that people used to say when I was learning options many years ago. Now, why is this important? Like I said before, it's because of the time. It's a very low stress way of trading. If you were trading a perpetual with this, you would always be watching what that chart's doing, because the moment you hit your margin level, you're at zero. Liquidated, done, boof, you lost your money. That's why perpetuals are high stress, and I don't recommend really anyone aside from a very dedicated day trader who knows what they're doing, who's sat in front of their screens all day long, watching their trades, or has a shit ton of margin. I really don't recommend anyone to trade perpetuals unless that happens to be you, or you really know what you're doing and you're comfortable with the risk. Options are a far better product because you have the time. You have the time. And time is a big important thing when it comes down to trading, because that's really ultimately what you're working with. You're working with conditions of the market. And like I say, anytime in that 13 days, you can close your trade for a profit. And the only loss you could ever have is the amount you paid in a premium. So hopefully that helps you guys understand what are options and why they differ from futures, okay? Now, I talked a little bit about how they're used. They're used to speculate, but they could also be used to hedge, okay? And how is that the case? How could you use an option to hedge? Well, I'm going to talk about it in a crypto context. So you could use an option to hedge, for example, if you are in a staking, like if you're in a stake, right? So let's pretend you have 1,000 Ethereum. You're very lucky, you have 1,000 Ethereum. And you're going to stake this. You're going to stake it for 120 days. Why? So you can get that validator money coming to you. So you're staking up 1,000 at 120 days. But there's a risk, right? Because the price of ETH is always going up and down or whatever. And let's pretend you staked this and it was $1,500 per Ethereum. Well, let's say 60 days into your staking obligation, Ethereum goes up to 3,000. And you're like, oh man, I would have loved to sell at this point. I really wish that I could have. Such a shame because I'm stuck in here for another 60 days. Probably the price is going to fluctuate. But what you could do at that moment is you can buy a put option, okay, which gives you the right to sell Ethereum for $3,000 in 60 days. So that way, if Ethereum went down even to like $300, pretend, horrible market, you can still sell it for $3,000 because you have that put option. And that might cost you, I mean, in this case, it probably will cost you quite a bit of money because you're talking about a lot of Ethereum, but it gives you that comfort factor. It's giving you the ability to hedge your bet while remaining staked and not lose that upside that you would have gotten. So this is a very important use for options, and it's a shame that they don't exist right now in crypto because they could be used a lot, and that's why we created Eve. So you can think about it also in another way. Let's say you are investing in a new token issuance, okay? Let's pretend you got it on a next hot initial coin offering or initial exchange, whatever, and it's an IEO, and you bought that token for 10 cents, but you got to vest for 60 days. Well, like every project, it has a big risk that it's going to go down, yeah? In that 60-day period while you're vesting. So the money you invested could be what, 10%, 20%, 30% lower. Not good. What you would simply do, again, in this case, is you buy a put. And you buy a put to have the right to sell it for 10 cents in 60 days. So in that case, the worst case scenario is you got your money back and you lost a little bit of money on the premium because you had to pay that premium to have that. It's called insurance in this case. So there's lots of use for options aside from taking speculative positions, and they're very important to have in crypto, and that's why we built Eve, because we have been in the market a long time and really can see the need for it. So let's talk now about options in crypto and DeFi, what's out there now, and why are we as Eve very different, okay? So in crypto right now, you don't have a lot of options trading. Like I said earlier, everything is perpetuals. All people want to know about is perpetuals. And it's a little bit silly for the reasons I said. Crypto options basically are trading somewhere in the range of $40 million in volume a day. Not a lot. Most of that's concentrated on a thing called Deribit. Deribit's a centralized exchange and it offers options contracts on 3 assets, Bitcoin, Ethereum, and Solana. That's it. They have 20 million in volume a day, and that is where most of the, let's say, options trading in crypto is participating at a retail and small institutional level. The rest of the market is shared by various DeFi protocols and a couple of centralized exchanges. None of them really got the traction. Again, I think it's because it's a complicated product hard for people to understand, not enough education. Perpetuals are taking the show. But like we said earlier, $500 trillion in options contracts are traded every year. So it's only a matter of time until the DeFi world wakes up and sees, hey, we should be looking at options trading. So when we're talking about this and we're talking about Eve, that is why we made the platform very flexible so that you can write options contract for any ERC20 token that is out there, okay? So whether that is a yield token, whether that is a speculative IEO token, whether that is doesn't matter what it is, a real estate token, doesn't make a difference what the token is. You can still write an options contract for it. So what do I mean by that? Well, when you write an options contract, you are the person who is basically, like you look at this, like you're the person that is the insurance underwriter in a sense, right? You are writing either a put or you're writing a call. And as I touched on earlier, you generally are buying puts if you think the asset's going to go down, and you buy calls if you think the asset's going up. When you're writing options contracts, you probably are thinking the opposite. If you're writing a put, you probably think that the price is going to go up, and if you're writing a call, you probably think the price is going to go down. But either way, you might not care because ultimately you're still getting paid that pretty nice premium. So with Eve, you can write and then you could trade any single ERC20 token. Very simple. All you need to do is load in one side, the tokens, write that contract, and then other people can trade it, and it goes into the order book, and they can buy it off you. You get the premium, they get the right. And what's good, it's always collateralized. You need to have the tokens available to write the contract. So now I'm going to show you how it works in the actual trading environment and get into a little more detail on the different circumstances you will maybe be interested in making these trades. So hopefully that explains to you a little bit what options are, why they're useful, and gives you a better understanding on how you can use ETH. So see you in the next video.